Okay, so today's chapter is about de minimis exclusion. Now, the moral of the story or the fundamental associated with this is, let's say that everybody has to come into pillar two framework, right? Any M&E group with a consolidated turnover of more than 750 million should come into should compute globe income, should compute adjusted cover taxes, should compute ETR, should compute SPIE and do it. So that's blanket applicability for all the entities in that M&E group wherever the jurisdiction is. But see, practically what happens is there might be some jurisdictions where the M&E group has entities, but it's only on a limited capacity. Say they may only be a representative office, or they might be doing some coordination work, etc. For that they have kind of like incorporated a company there. So when there is no major value addition, it's a limited risk, limited coordination work which is done now. uh, you know because of pillar 2, now we have to compute the globe income of that, you know top up, calculate the top up tax liability and all. So it on a compliance basis it becomes a nightmare. If for the small dormant and little entities we have to compute globe income and consolidation, and then the compliance costs go very high. So what they have done is they have excluded certain jurisdictions. So you have to see it on a jurisdictional basis. Certain jurisdictions which are excluded from pillar 2 calculations altogether because of very limited business. Okay, very limited revenue, very limited income. So in that case, they are kept excluded. So we'll understand who are the entities, or how does a de minimis exclusion applicability trigger in for a particular jurisdiction. Now, if the de minimis exclusion triggers in, that entity may not compute anything, may not do any top-up tax liability, need not file any globe income return, etc. Nothing in relation to IIR and UTPR. So if there is QDMTT there, and QDMTT specifically says this is not a de minimis exclusion, then you have to kind of do it for the QDMTT process. But since to get a qualified status, it has to mirror. Most probably, QDMTTs would also accept them. So we'll see what triggers this de minimis exclusion. Okay, so after completing this chapter, you will be able to apply the de minimis exclusion to eliminate top up tax liability for jurisdictions with minimal operations. So calculate, we'll see how it is done. Okay, so the global minimum tax framework addresses profit shifting, but its jurisdictional scope could impose disproportionate compliance burdens on modest operations, say dormant entities or small representative office or a limited coordinating office. For those people also, computing globe income and top up taxes and all is going to be a compliance nightmare. So what they have told us, this de minimis exclusion provides relief by creating objective thresholds below which jurisdictions are excluded from ETR and top up tax calculation entirely. Okay. So no top up tax calculation at all. It targets jurisdictions with less than 10 million euros in revenue and 1 million in profit. So if your jurisdiction as a whole, okay, so there are multiple entities in the jurisdiction, you'll have to take all them combined. And if they have revenue of less than 10 million euros, so which is something around 40 million euros, 40 million AED, and 1 million in profit. Okay, if both, so sometimes it might have only small revenue, but it would have super profits. So to kind of check on both, it should, if it is less than 10 million in revenue and 1 million in profit, then you may qualify for a de minimis exclusion. Okay. Now, why would they give a de minimis exclusion? I think that idea is clear. The exclusion provides compliance relief for jurisdictions with minimal operations. If both thresholds are met, by both thresholds, I mean the revenue threshold of 10 million euros and income thresholds of 1 million euro, the M&E group does not need to calculate adjusted cover taxes, no need to calculate ETR, no need to have any top up tax liability for the jurisdiction. So the globe income and top up tax for the jurisdiction are deemed to be zero. Okay, so this is what the de minimis exclusion. It's kind of a minimum thing. So like let's exclude it from the scope because the top up tax that I collect from it would be lesser than the compliance burden that they have to put into. So let's kind of like don't take those kind of companies into the equation at all. So this is de minimis exclusion. Now let's see the qualification criteria. Qualification criteria, you already know the base criteria, which is 10 million in revenue and 1 million in profit. Both has to, if the jurisdiction has less than that, then we will go forward. Now, how to calculate this 10 million and 1 million? This is what is important. So a jurisdiction qualifies both test parts. Okay, revenue and profit. So revenue, how do you calculate? Average global revenue is less than 10 million euros and average globe income is less than 1 million. Or if it's a loss also, it's fine. Okay, loss also, it's fine. So it says we will measure the size of operations as well as profitability of operations, and then only you will get a de minimis threshold. There could be a question in exam why they need two tests. So it's not just the size, but if it's a smaller size, but if it's getting too much of profit, then there is potential for profit shifting. So both has to be qualified in order to get the de minimis exclusion. Okay. Now, critical points here is that both tests must be met. Okay, passing only one does not qualify. If say less than 1 million also includes losses. So if you have losses, then also the second threshold, which is profit of less than 1 million, is qualified, is passed. Globe amount should be used. So you have to see to calculate, these things, right? I mean, to calculate, the revenue as well as income, you have to use globe figures. Okay, what would be the globe revenue and what would be the globe income? Not use like what is there in your local accepted accounting policies or CPCR. You have to calculate globe income basically, but you don't need to calculate adjusted cover taxes. So globe income should be less than 10 million or 1 million as the case may be. And it is an annual election, so it is not automatically excluded. You have to elect for it. Okay, I am meeting these conditions and I elect to be a de minimis. So that annual election should be taken. Okay, and it is not one time, it has to be done annually. Okay, now 3 year averaging, the thresholds use a 3 year average, so it's not your current year thing. Okay, maybe current year you are a little less because of some regional fluctuations or like market disturbances, but you have to satisfy, you have to take 3 year average of both globe income as well as globe revenue, and then see if you are going below 1 million or 10 million as the case may be. So you have to always use a 3 year average, because using the current year one will not kind of like give the may account for regional disturbances. Okay, so 3 year average of the current fiscal year. So if you're calculating for 25, you have to take 3 year simple average. Okay, A plus B plus C divided by 3. So you have to take 2025 and preceding 2 years, 2024 and 23. Don't take for calculating the scope whether you are in scope of globe. We took the 4 previous years. Okay, but for de minimis you have to take current year and 2 preceding years. So that is how you have to calculate. So average globe revenue is financial year minus 2, financial year minus 1, and financial year divided by 3. Okay. So this is how you have to calculate both revenue as well as income. So if you want an example, like let's say that we are calculating the globe de minimis exclusion for this year. So in the current year, I can see that they are less than 10 million of globe revenue as well as less than 1 million of globe income. But that does not satisfy. You have to take the 3 year average. So if I take a 3 year average, it would be like revenue would be 25 million divided by 3, which is around 8.3 million. So it is less than 10 million. So it passes. Income also 1.95 million divided by 3, it is around 650,000. So it is less than 1 million, and it also passes. So this is how you have to see and check whether they qualify for those two rules under globe. Let's take a moment here and ask you guys, is it clear? This is pretty simple. You just have to do, you get a de minimis exclusion here. Can somebody tell me if it is clear or not? Thank you, Mel. Okay. Now, there are a few excluded years also. Certain years are excluded from the averaging calculation. So, which are the years? So, let's say that in that jurisdiction, and one more thing, it is not entity wise, it is jurisdiction wise. Okay. So, let that sink in. It's never an entity wide calculation. Now, for excluded years, 7 years are excluded from averaging. So, let's say that there are no constituent entities in the jurisdiction for that year, or it is dormant entities or pre-globe implementation. If that year is excluded, the average is calculated over fewer years. So, let's say that there are no constituent entities in 23. We are calculating for 25. 23 there was no constituent entities, or it was dormant. That meaning whereby the revenue and income are zero, no activity at all. Or if it is a pre-globe implementation year, then we will take the average. Okay, we will take the average of the remaining year. So let's say that 25 is the first year in which globe is to be implemented in UAE. So the 23 and 24 become pre-globe implementation years, right? So for 25, you will only take for that year. Okay, so for that year globe income and revenue, you have to see whether it is coming meeting the threshold or coming under the de minimis exclusion. Okay, so let's say that scenario. So let's take a scenario. So entity established in financial year 24. So there are no operations in 22 or 23. Okay, so and we are calculating for 25. So average 2 years, which is 25 and 24 divided by 2. So if it's a first year of operation, if it's current FI is a first year with constituent entities, only current figures are used, no averaging required. Is that clear? Excluded years. You only take what is available, and you have to also see if it is dormant. If it is 0 0, then you don't take it. Okay. Yes, this is very important. I told you the threshold is 1 million euros and 10 million euros, as the case may be. So if your reporting currency is something else, so let's say it's AD or USD, you have to convert definitely to check whether you are meeting 10 million or 1 million. So which rate would you take? So that is the whole equation here. So thresholds are in euros. Convert non-euro presentation currencies using the average exchange rate for December of the calendar year immediately preceding the start of the M&E Group's fiscal year. So you have to take this. What is the rate on average exchange rate for December? So December as a month, what is the average exchange rate? The December which concluded prior to the start of the M&E Group's fiscal year. Okay, so just to understand this, like it's a lot of words. Let me. So let's say what they're trying to say is you have to convert, obviously. So while converting, for example, let's say that it is, year end. My fiscal year is January to December 2025. Okay, and my reporting currency is AED. Which rate would I use to convert, the figures for the year globe income and revenue for I have to do for 23, 24, 25, right? And those would be in AED. So which rate would I use? Can you tell me which rate would I use? How do I convert this into euros to check if I come under de minimis exclusion? So you have to look at your financial year. The December that concluded just before your financial year. So in this case, since my financial year in question, where I'm calculating the de minimis is January to December 25, the immediately concluded December is December 2024. So I will take the average AED to EUR rate on December 2024. This is clear? Now I'll flip the equation a little bit. So let's say that my fiscal year is April to March. Okay. Now which rate should I use? Which rate should I use? Yes. So if my financial year is April to March and I present the my reporting as an AD, which rate would I use to convert my globe income and revenue for these 3 years? Okay, so 23, 24, 24, 25. Sorry, 22, 23, 23, 24, and 24, 25. Globe income to check de minimis. Which rate would I use? Okay. So we will still use the December. So we have to take the financial year, which is the December, which is recently concluded, and that is 2024 December, right? So you will keep on using the average EUR to AED rate on December 2024. Okay. So this is how you have to take. So average rate for December of the calendar year immediately preceding the start of the M&E group's fiscal. So that's how you have to consider the conversion. So, for example, let's say that it's a USD reporting group. M&E group financial year is January 1 to December 1. Presentation currency is USD. So, since it is January to December 25, I will take the rate of, I will average the rate for December 24 as a month. So, December 24 average rate is 1.08, and I would have to convert. So, let's say either you kind of convert from USD to um, like EUR to check this, or you convert whatever is the figures, threshold figures in EUR, multiply this rate and see if you are exceeding this amount. Either way is fine. Okay. So this is currency conversion, and how to use it. So why we are using the December average rate? What is the fundamental behind it? It is using the December average rate from the year before the fiscal year begins provides certainty. Converted threshold can be determined in advance. Exchange rate fluctuations can cause marginal jurisdictions to move in or out of qualification, making regular monitoring important for groups operating near the threshold. So let's say that why they are kept it as December of the calendar year before the start of the financial year is because I know for a fact certainly what is going to be my rate. Okay, and I know that before the start of my financial year itself. So let's say that I'm kind of like going and reaching somewhere. I know beforehand that I would not come to a de minimis exclusion, or I will come to a de minimis exclusion. You understand? So I can predict whether I will go and reach a de minimis exclusion before the conclusion of the year. As a matter of fact, before the start of the year itself, I can kind of get the rate. So it's since I have 23 and 24 years, by 25, say October itself, we can see whether we will come into the scope, so that you will not miss out. That is why they are using the December rate of the year before the for the calendar year before the financial. Okay, so this is the fundamentally why they are using this particular month for calculation. Now there are some entities which are excluded from de minimis, meaning by those entities, even if they are having a revenue of less than 10 million and an income of less than 1 million, they will still not qualify for de minimis. They have to do top of tax calculations, and these are stateless constituent entities. So stateless, I am telling you that it does not form a part of a jurisdiction. Okay, it has to always be calculated separately. So since there is no jurisdiction per se, stateless constituent entities never qualify for de minimis, excluded from threshold calculation. So you have to see if it is a stateless one, if it is a foundation or a partnership or similar structures are there in the M&E group, then they are stateless. I mean, depending on the conditions, and they never qualify for de minimis. Also, investment constituent entities, they never qualify for de minimis. Now, about investment constituent entities, we will learn in chapter 7. Right now, we are in chapter 5. So, what is the significance of the investment constituent entities and others? We will slowly come there. But always make sure that stateless and investment constituent entities would always be excluded from de minimis. Okay. Now, treatment of excluded entities, if they are, when calculating whether a jurisdiction qualifies, let's say that you have to do it jurisdictionally, right? So jurisdictionally, what you have to do is remove the revenue and income of stateless entities if they are incorporated in that jurisdiction, and remove the revenue and income of investment constituent entities of that jurisdiction. Calculate thresholds using the remaining constituent entities. So if your jurisdiction has these two types of entities, remove them from the calculation altogether. You don't need to add it to calculate. Okay, I understand that these two will not de minimis will not apply, but still, for calculating the 1 million and 10 million threshold, also you can remove them so that the other constituent entities are also not a part. Okay. So jurisdiction with mixed entity. So let's say that for example, so let's say this is a jurisdiction. So there is an operating company, okay, which has globe revenue and globe income they have already given. So and there is an investment company. So there are two entities in this jurisdiction, okay, and one of them is an investing entity. So which revenue and globe income would you take for de minimis test? You will take only this, you will exclude. And now if you see, it is 6.5 million and 480K, which is lesser than the thresholds, both the amount. And then this opco A is excluded on de minimis basis. Okay, so no globe calculations at all. As a matter of fact, this jurisdiction itself is excluded. Only this has to be done separately. And what is the significance of that? We will learn when the time comes. Okay, so result Investco excluded from calculations. Jurisdictions may still qualify or OPCO is figures. If I add, what would be the condition? So let's say if I add, I would be out of scope because even though my revenue is 6.5 plus 3.2, I think it's 9.7. But if you see my income, this particular person itself is going around 1 million. So I will crash out of the, so that means if I am adding both together, OPCO and Investco, then OPCO will be coming under scope. So in order to avoid such disturbances, if you have an investment company or a stateless entity, remove them from the whole thing and then calculate. Okay. Now, theory. Exclusion of stateless and investment entities from de minimis calculation reflects their special treatment elsewhere in globe rules. Stateless entities, those without a tax residence, present unique concerns because they have no jurisdiction that can impose minimum tax, making them subject to specific anti-avoidance provisions. Investment entities are governed by separate rules in Article 7.4 and 7.5, which we will learn later, that addresses their particular characteristics, including either category in de minimis calculation would distort the measurement of ordinary operating activity in a jurisdiction and could create opportunities for structuring around thresholds by adding or removing such entities. So this is just to avoid tax planning. Okay. And I told you this is not an automatic thing. We have to elect every year. So just like your small business relief, which is I'm not sure if it's one time or annual, but this particular thing it's annual. So you have to see whether you meet the thresholds, and then you have to elect annually. So when you elect, you have a small return, just like your SBR. You get a very miniature return. Okay, my revenue is less than 10 million and my profits are less than 1 million. So I get a tiny return. Khatam. Your tax return is filed. Okay. So de minimis exclusion is an annual election as per Article 5.5.1 and must be actively elected each year. Jurisdiction may qualify for 1 year but not the next. Why? Because the next year I may kind of increase the thresholds. So that's why they're keeping it as an annual election. Election is made jurisdiction by jurisdiction. Yeah, and it's not made at the top by the MNE, it's made by each jurisdiction. So for each jurisdiction, you have to choose whether it is, this will apply or not. And no binding effect on future. So just because you choose an annual election this year, it would not have any effect for next year. So it's an annual thing than a recurring irrevocable thing. So year by year assessment you have to do. So let's say that for 2024 average revenue is 7.2 million, average income is 0.6 million. So would I qualify? Yes, because revenue is less than 10 million and income is less than 1 million. So I can make the election. In FY25, I am having an income of more than 1.3 million. So I can't make the election. Okay. So just because I lost out on financial year 25 and 26, still if in 27 I'm lesser, I can make. Okay, so it's not like SBR in the pure sense that once you're out, you're out. No, you can make every year. So this is one thing that you have to understand about the annual election requirement of de minimis exclusion. So monitor thresholds annually, eligibility can change. Okay. Now there is a small thing also. This is called the transitional CBCR safe harbor de minimis test. Now you have learned about few safe harbors now. One safe harbor which you learned is QDMTT safe harbor. I hope you understand what it means. Now the next one is transitional CBCR. If anybody has a doubt on QDMTT safe harbor, it is just that if your jurisdiction has a QDMTT safe harbor status as mentioned in the central record, then there won't be any IIR on UTPR. You would end with QDMTT only. Now let's understand what is CBCR safe harbor. Okay, minimum de minimis test. So what they are saying is for the transition layer. What is transition layer? Transition layer is the first year. So in UAE's case, 2025 is the transition layer. Now, for the transition layer, a simplified version of de minimis test is available. You see, for calculating this de minimis exclusion, you have to calculate globe income and globe revenue, right? So, calculating this globe one means putting into action articles 3 and 4, which could be a little complicated because you have to spend money on a consultant who knows how to do this. So, in order to kind of like, save really small people from incurring compliance costs, what they did is they include a simplified version of de minimis test. Okay, and this is called CBCR Safe Harbor de minimis test. Now, what is the simplified transition test? Is that instead of the globe amounts, you can use the CBCR data, the income and revenue that is mentioned in your CBCR. Because see, if it is an M&E group which is in scope, meaning which has a 750 million euros and above, then it will come into CBCR also. Right. So it would have, if in UAE's case, if the local entity is not maintaining, the parent entity should maintain CBCR data and they have to file the country by country reports. So that would be there. So instead of taking the globe amounts, you take the CBCR data and you don't average it for 3 years, you just take the current year CBCR data. Okay. And check whether the revenue and income is less than the thresholds. On addition to that, there is one more rule, which is that there is an ETR threshold. So if you are taking a transitional CBCR safe harbor, there are three thresholds: revenue threshold, income threshold, and ETR threshold. So ETR threshold, what they are saying is, there is a table just like SBI, which says like for 23-24 is your transitional year, then your ETR threshold should be minimum 15% also. 15% calculated using CBCM. So your ETR threshold should be 15%. If it is 2025, it should be 16%. If you have a ETR of 16%, then it's fine. You can use transitional safe harbor instead of the standard de minimis. And if it is 26, 27, that's when you're starting, then it is 17%. I don't think any country will start after 27. If it is there, then they will increase the table. But when you're starting, you have to satisfy this ETR test, then you will get a transitional safe harbor de minimis test. Okay, transitional CBCR safe harbor de minimis test. And this is available, like, this would be available every time. Like this standard de minimis rule would be there forever. But this transitional safe harbor is only on if you guys are starting the the pillar 2 framework before for financial year before 31st December 2027, you have to start, and not including any financial year ending after 30th June 2029. So it would only be for these guys. That's why there are only three numbers on the table. Okay, so transitional safe harbor will not be allowed to any entities which is whose let's say they're starting from 2028 1st January 2028 is when we are starting the pillar 2. The transitional safe harbor is not there. There's only standard de minimis. Okay. So that is what you have to understand about transitional safe harbor. Why there is such a rule is because it will save a lot of time and effort in terms of making the globe amounts and globe. Okay, in terms of like making the globe amounts for this analysis. Is this clear? Okay, fantastic. So when to use the transitional test? When could you use the transitional test? It is advantageous when CBCR data is readily available. Okay. Globe income calculations are burdensome for small jurisdictions, and the jurisdiction would clearly pass the CBCR based thresholds. So, if majorly if your CBCR data is readily available, then you can try this transitional one. Only thing is that while going with transitional CBCR safe harbor, there is one more additional threshold, which is the ETR threshold, which you have to. But still, like compliance wise, it is quite easy. You don't need to calculate a globe income at all. The transitional CBCR safe harbor de minimis test provides meaningful simplification during the initial implementation years. Many M&E groups already prepare CBCR as a part of their BEPS compliance obligations, making CBCR data readily available without additional calculation. While CBCR revenue and profit figures differs from globe revenues and globe income, they provide a reasonable proxy for identifying small jurisdictions. The single year measurement eliminates the averaging calculations entirely for jurisdictions clearly below the both thresholds based on CBCR data. This offers substantial compliance savings during transition period while full globe calculation infrastructure is being developed. So this is how you have to present in your exam, like the words that they use. Like you understand what it means, but if you can work on your wording also, then that would be a very good answer. Okay, so this is what is de minimis exclusion. So let's get to the summary. So what is de minimis exclusion? So what did we learn in de minimis exclusion? It is a compliance relief for jurisdictions. So first thing is like it should be a jurisdictional basis. So you have to add all the entities in jurisdiction to check the thresholds. Okay. So what are the thresholds? So it is euro 10 million of globe revenue, not anything. So you see, you have to calculate the globe revenue for 3 years in order to make a simple average. So it's not just 1 year, you have to calculate 3 years globe revenue and globe income plus EUR 1 million of euro. So globe calculation should be made for 3 years in order to kind of check the thresholds. Then what did we learn? In order to like then there is currency conversion. You see December here, December average rate before the start of year. Okay, and four there are like exclusions. This itself is an exclusion, but there are like which are like not applicable ones, which are stateless entities and investment entities are kept out of this. And while calculating the threshold of that particular jurisdiction, you can take them out of the calculation entirely. Then what did we learn? Then there is something called transitional CBCR safe harbor de minimis test. So which is basically nothing but if you have if you have CBCR data it would be easy. Okay, you can use CBCR data instead of the globe data. So that's the whole thing. You so that your computations are lesser. Use CBCR data instead of globe data. And what it will do, only addition is instead of two thresholds, there are three thresholds, which is the income, revenue, and there is an ETR test. Now you tell me, is this clear? De minimis exclusion. Why it is done? How it is done? What is the rationale for using December? What is the so that you know beforehand, before the start of the year itself, what is going to be the rate? Okay, and you know what is the rationale for giving transitional CPCR safe? No, and also one more important thing that you have to kind of net in notes is it's an annual election. Okay, annual election to be done every year. Okay, is chapter 5.5 clear? This is article 5.5 also. So whatever is the chapter names, right? This is corresponding to article. It's purposely made so that we can. It's easy for to remember. Okay, thank you, Ashik. I hope it's pretty simple. Okay, it's pretty simple. There is no deferred taxes or there is no other major accounting in use here. Only thing you have to understand is there are few things that you have to understand while taking a de minimis exclusion. And if you are clear with all this, I think we can move forward. Okay. So tomorrow we will take 5.6 and we will close chapter 5. Any doubts at this point? No doubts. Okay. So see you tomorrow.